Hi everyone, I hope you guys are studying well for your examination. Today we will be doing a quick revision of the Companies Act for CA Inter. So you can view the video either before you start revising your Companies Act or probably once you're done revising your entire Companies Act to refresh the entire law. Okay, so now without further wasting any time, coming to what the Companies Act 2013 is applicable to the entire India, and it's applicable to companies, it's applicable to banking companies, insurance companies, any company supplying electricity, or any other company which is covered under the special act. What is a company? Company is a company which has been incorporated under the 2013 Act, or any company which has been incorporated under the erstwhile Companies Act 1956. What are the different types of companies? There are different type of companies based on the liability of the members. There are three types of companies: company limited by shares, company limited by guarantee, and an unlimited company. Now, company limited by shares is basically which has a share capital, and the amount of the liability of the members is limited to the amount of unpaid amount on the shares. Company limited by guarantee is where the members give a guarantee that this is the amount we will contribute if there is any if the company goes into liquidation. So that is the amount and that is the extent of liability of the members. Unlimited company is where the liability of the members is unlimited. Coming to on the basis of number of members, we have the private company and public company. Under private company, you have the OPC, which is a one-person company. That is, only one person can come and form a company. That one person will have to appoint a nominee, and that nominee can be changed at any other time if required. Not all the acts which are applicable to the private company will be applicable to the one-person company, so they get certain exemptions which are not applicable to certain exemptions, which means that not all the provisions of act are applicable to the one-person company. For example, the notice for calling a meeting is 21 days clear notice, but here in case of OPC, the 21 days notice is not required, and they can also have a 15-day notice that can be given for the purpose of calling of meeting. Minor cannot be a member of the OPC, and they cannot be a Section 8 company, which means that OPC cannot be a company which is formed for charitable purpose. Then coming to private company, you have minimum number of members 2, maximum number of members 200. While calculating the maximum number of 200, any shareholder who's given shares under the employee stock option scheme will be excluded in calculating the maximum number of 200. The transferability of shares is restricted. In public company, minimum number of members is 7, and maximum numbers, there is no limit on the maximum number. There's free transferability of shares, and a subsidiary of a public company will also be deemed to be a public company. Now coming to holding company and subsidiary company. Holding company which has a subsidiary company is called a holding company. Subsidiary company is where the other company has a control over the composition of the board of directors or controls more than half of the total share capital of the company. And a subsidiary of a subsidiary will also be considered to be a subsidiary company. Then coming to associate company, which has a significant influence. Significant influence is controlling more than 20% of the total voting power or control or participation in business of the company. A joint venture will also be covered under the definition of associate company. Quickly brushing through all of this because this you've already studied in your foundation, so doesn't make sense wasting a lot of time here. Then you have the listed company, unlisted company. Listed company is where the shares of the company are listed on any recognized stock exchange. Unlisted company where the shares of the company are not listed on the recognized stock exchange. Government company is any company where the central government, state government, or any other government holds a stake in the company. Okay. Now coming to a small company, the turnover is less than 10 crore rupees and the share capital less than 50 lakh paid up share capital. If both the criteria are met, then it will be called as a small company. And it should not be a Section 8 company. Again, Section 8 company cannot be formed. Holding or subsidiary company or company governed by any special act like the Banking Act or the Insurance Act. Foreign company is a company which has been incorporated outside India, but why will it be governed under the Companies Act? Because they have a place of business in India, they are doing any activity in India. In that case, it will be covered under the foreign company definition. Now coming to Section 8 companies which have been excluded from OPC, which has been excluded from small company. Section 8 companies are companies which are formed for charitable purpose. They are formed for the purpose of promoting certain objects, and they have a lot of restrictions. They are approved by the central government. They have a lot of restrictions on the functioning, and they have to report their activity to the central government, and they do not comply with all the provisions of the act. They have kind of exemption from certain provisions of the act, provided they fulfill the criteria which is given under that particular section. They do not give out any amount as dividend because it's formed for charitable purpose. So whatever profits they earn, if any, will be used only for the functioning of the business, and they cannot declare any dividend. So that is a Section 8 company. Now coming to the Memorandum Articles of Association, the two main charter documents of the company. Memorandum of Association gives you the objects of the company. Article of Association is for the internal working of the company. Memorandum of Association, they have a different clauses under the memorandum, which is your name clause, domicile clause, object clause. All of these clauses are given in the Memorandum of Association. If you have to change any of these clauses, you need to pass a special resolution, and in some cases you require approval of the central government is necessary. Which cases? If you are changing the name of the company, if you are changing the location, the address of the company from one state to another state, in that case you will require. Then you have the object clause, the purpose for which the company has been formed. Shareholders make investment in your company looking at the objects of the company. If you are planning to change your objects of the company at a later stage, you have to give a notice on the website and in a newspaper saying I am planning to change the objects of the company, and the shareholders who do not agree with that objects are given an option to quit. So the dissenting shareholders are to be given an exit opportunity by the company. Then there's a liability clause, limited by shares, limited by guarantee. All of these, if there is a change in the liability clause, then that has to be also that also requires a special resolution to be passed. Subscription clause is the people who are subscribing to the memorandums and articles of association. Now articles of association, if I have to change, articles of association is all about how the internal functioning of the company is. So if I have to change my articles of association, I will need a special resolution to be passed. If I am converting private company to a public company, it's fine. But if I am converting a public company into a private company, then I will need approval of the central government. Why would I require that? Because I'm a public company, I may have accepted deposits from the public. If I'm a private company, I'm not accepted any deposits from the public. It's to a limited number of shareholders. So I'll need, if I'm converting from public company to private company, I will need central government approval. Otherwise, a special resolution is required. Alteration has to be informed to ROC. This is a very standard clause. Any changes you make to the company anywhere, anything you do, or any declaration of dividend or change in memorandum, change in articles, or anything you do has to be informed to the ROC. You file minutes of the company, you have to file it with ROC. You've issued a notice, you've called a meeting, annual return, everything has to be filed with the ROC, and that has to be filed either within 15 days or within 30 days max. And once the alterations are accepted, the new AOA will be considered to be the AOA applicable to the company. Now, what are the steps for incorporating the company? The first thing that I will do is file a name reservation. Once the name has been reserved, I will give my memorandum and articles of association and the person who are going to act as directors. So they give their consent to act as directors, a statutory declaration of compliance and other declarations saying that, they have not been any criminal record and they have not done anything under any other act and things like that. And then once all of this is done, you pay the fees and you get the certificate of incorporation, and then you file a declaration about the registered address of the company. So once your certificate of incorporation is given under section 10A, you will have to file a declaration by the director that all the compliances have been complied with. The share capital, which have paid up share capital which was supposed to be paid, has been paid by the directors or the first subscribers to the company, and that the registered office confirmation that the company is going to function from this place. So that is how the procedure of the formation of the company is. Now, if you have number of members and the number of members have reduced below the limit, so if my private company, the number of members have reduced below 2, or in case of a public company, the number of members have reduced below 7, then if I have I have to restore it to 2 or 7, whatever the case may be, within a period of 6 months. If I've done that, then I have to inform and file a letter with the ROC in the prescribed form. If I don't do that, then the person who have been functioning the company for a period of more than 6 months without meeting the minimum criteria which is required, they will be personally liable, and their liability in that case will be unlimited. Okay. Now, coming to the registered office of the company. Registered office of the company is the place from where the company is going to carry on its business. This registered office address will be put on all the letterheads, and all the registrar of companies will also be informed about what the registered office of the company is. And where the registered office of the company is, you will place a nameplate saying that this is the registered office of this particular company, and you will put whether it's a private limited company or it's a limited company. And within 30 days of incorporation, you will have to inform RO about the registered office of the company. Okay, in case of one person company, you will have to mention the words one person company so that people know that it's a one person company. Now, change in place of business. This is a very important clause. If you are changing the registered office of the company, if you are changing the registered office of the company within the city, if I am changing from Mumbai Andheri to Mumbai Bandra, I don't have to do much. I just have to pass a board resolution, and then I have to give a notice to ROC, because anything I do has to be informed to ROC. So, ROC you have to inform within 30 days. If I am changing within the state but from one ROC to another ROC, so from Mumbai to Pune, then I'll have to pass a special resolution, and I'll have to give a notice to the ROC within 30 days. If I am standing within a state, from one city to another, Mumbai to Pune, then you'll have to have a special resolution and ROC 30 days. If I am changing from one regional office to another regional office, I will have to pass a special resolution, which is common, but I will have to take the permission of the regional director of the company, who will give me an approval within a period of 60 days, and then I will file that application with the ROC within a period of again 30 days. And if I am changing from one state to another, I am going from Mumbai to Delhi, then I'll have to file a special resolution, and I will have to take an approval of the central government within a period of 60 days. Once he gives me the approval, then I'll have to inform the ROC within a period of 30 days, and I'll be given a fresh certificate of incorporation. Now, if I am a subsidiary company, I cannot hold shares in my holding company, because the holding company is already holding shares in my company. So, I cannot hold shares in this holding company. But before the holding company acquired shares in the subsidiary company, if I was holding shares prior to that, then I can continue to hold that shares in the holding company. Now, exceptions to the point where I can hold the shares in the holding company is if I am holding it as a legal representative, I am holding it as a trustee, or I become a shareholder before it became the subsidiary of the holding company. And authentication of documents. All the documents which are issued by the company has to be signed by key managerial person. Key managerial person would be people like CEO and MD of the company, company secretary, whole-time director, CFO, such other officer more than one level below the director who is in whole-time employment designated as a key managerial person, or any other officer who may be prescribed as a key managerial person. So, this is what is your basics which we have studied last year. Now, coming to the new part. Issue of securities. If I have to raise funds, I have to issue securities. But can I issue securities by all ways and methods? No, I cannot do that. It depends on whether I am a public company or a private company. So, how do I raise funds for my company? For the purpose of better functioning of the company. If I am a public company, then I have different ways of issuing securities. First is my initial public offer, where I go to the general public and raise my money from them. Second is private placement, where I decide from whom I have to raise. I select the people from whom I want to raise, A, B, C. I tell them I want to raise the money from them, and I issue the securities to them. In that case, the number of members cannot exceed 200. Then coming to the rights issue of shares, where I give the existing shareholders an option to subscribe to further securities at a price which is lower than the market value. And then comes the bonus issue of shares, where I tell them that okay, you are already an existing shareholder, I am giving you a bonus issue of shares that can be done out of securities premium, free reserves, all of that, but it cannot be issued from revaluation reserve. So bonus shares cannot be issued from revaluation reserve account. This is important because this has been asked in case study type of questions. Now coming to private company. Private company, because it's a private company, it cannot raise money from the general public at large. So the three options which are available to private company is private placement, rights issue of shares, and bonus issue of shares. Now coming to the initial public offer. If I want to do initial public offer, I have to give out the details of why I am issuing the shares and what I am going to do with the money that is going to be raised, what does the company do, what are the financials of the company. All of these things, all these important matters form the part of the prospectus. So prospectus is like a big 300-400 page document which gives you all the details about why I am raising the money, what is the past history, what are the directors, what do the directors do, what is their background, all the details, what I will do with the money that I am raising, what are my objects, how I am planning to expand. Once I raise the money and I go into this particular business, what kind of financial return am I expecting in what are the projections of financials for the future years. All of this will form part of the prospectus of the company. So what are the contents of the prospectus has been given, and these contents of the prospectus has to be filed with SEBI and it has to be filed with the registrar of companies before you actually make the public issue of shares. Now there are three different type of prospectus. One you have is the abridged prospectus, one is the shelf prospectus, and one is the red herring prospectus. What is the distinction between the three different kinds of prospectus? Abridged prospectus is a summary of the prospectus which is given. I told you that the prospectus is like a 300-400 page document. If I am going to apply for a IPO, I really don't have the time or the interest in reading like 400 page document, correct? So in that case, the company gives you like a very like a 10 page thing. The font is written in like very small font and it's given to the company, which is a summary of the prospectus, and it's given to you so that you can read through it. It covers only the important points which are necessary for you to know before making the application for the IPO. Then coming to the shelf prospectus, if I have issued equity shares right now and I know I am going to issue the same kind of security after 3 months and again after 6 months, if I know I am going to do the same process again, then the entire process of making and filing the prospectus is a very lengthy thing. So the government gives you an opportunity saying that okay, you don't have to file it every time. You have a shelf prospectus. If you are issuing the same kind of security, then you can use the shelf prospectus again with the changes which are required for that particular IPO, and then file the same with SEBI and give it to the people who are going to invest in the company. And the third is the red herring prospectus. Red herring prospectus is like the normal prospectus, no changes at all except for two. One is that you will the quantum is not mentioned and the price is not mentioned. Quantum and the price is determined based on the demand in the market by the public, and then the quantum and the price is filled up and filed with the SEBI and ROC. If there is contravention, then penalty is applicable. Okay. Now allotment of security. So once I have made an application and people have paid the application money, if it is not less than 5%, then I will have to allot the securities to the people who have made the payment for the who's made the payment for the application money. If I have not received the required amount of people who are subscribing to the securities, then within 30 days from the date of issue of prospectus, if I have not issued, then I will have to refund the amount to the investors within a period of 15 days from the closure of the issue. If I do not return, then I will have to I'll have to pay interest. If I have taken application and if I have allotted the securities, then I'll have to find a statement of allotment along with the ROC. If the whatever is stated in the prospectus, if there is any wrong information mentioned or something which is hidden from the SEBI, ROC or the general public at large, then there is a liability. Liability depends on whether it's a civil liability or a criminal liability. Criminal liability will be when there is an intention to cheat the people, mens rea is there, then it will be considered to be a criminal liability, otherwise it will be a civil liability. If it's a civil liability, then the company director, proposed director, promoter, expert, everyone who authorized the prospectus will be fined. If it's a criminal liability, every person who was involved in the process of authorizing the prospectus will be liable under section 447 of the Act. Obviously, they have certain defenses which they can give in case they are charged for a thing. Now coming to private placement. Private placement, as I said, is where I am not issuing the securities to general public at large. I am issuing securities only to select set of individuals and select set of individuals or companies, whatever it may be, saying that okay, you are the people, I want you all to subscribe to the securities of my company. So private placement is for a specific number of people, select group of persons and companies, and you give them a private placement offer come application letter. So in that case, you don't have to follow the entire procedure of filing prospectus with SEBI. Now, you cannot make private placement to more than 200 people. 200 people will not include your qualified institutional buyers or people under the employees under the employee stock option scheme. Once the application money has been received, you will have to allot the securities within a period of 60 days. If you do not allot the securities within a period of 60 days, you are supposed to refund the money. If you do not refund the money, you will have to pay a 12% interest. If you do not comply with the provisions of the law, then there is a penalty for contravention of the law. Okay, so all of that is given here, allotment within 60 days from receipt of application. If not done, you will have to pay 12% interest. Now coming to share capital and debentures. Share capital, as we studied, we have equity share capital and preference share capital, the two most important things. Preference share capital are preference because they get a preference over the equity shares, so they get preference in respect of dividend and preference in case of winding up of the company. Equity share capital have a higher risk but have a higher return, so if the company is doing very well, preference share capital will get a fixed amount, but equity share capital can get more. So they have high risk, high return, they do not get preference, and hence it's equity share capital. They get payment only after the preference share capitals are paid, because the preference share capital has a preference over the equity shares. Now in equity shares, you have with voting rights and with differential voting rights. Normally all the companies will issue the shares which are given at the same voting rights, so everyone has equal voting right in the company. But there are a very few companies, including you would know the Future Retail, which has issued shares with differential voting rights. So every person has differential voting right in the company. Not many companies do that, but we do have companies which do that. And then you have the preference shares. Now types of preference share. What type of preference shares are available in the market? On the basis of dividend payout, cumulative and non-cumulative. Cumulative is where it gets accumulated, non-cumulative which is paid year on year. Participatory, non-participatory. Participatory is where they can participate in the business of the company. Non-participatory, they can't. Normally preference shareholders will not get participation in the business or the voting power, voting of the company, unless their dividend has not been paid for a period of 2 years, or the meeting has been called for a purpose where the rights of the preference shareholders are affected. In these two cases, they will get a right to voting power, otherwise they will not get any voting power in the company. On the basis of convertibility to shares, so preference shareholders now, after a period of X number of years, your shares will converted into equity shares. So that's called convertible shares or non-convertible, where they will not be converted into equity shares. They will be preference shares only and will be redeemed after a period of time. On the basis of redeemability, redeemable shares and irredeemable shares. Redeemable shares is where you have collected, suppose 20,000 per share per preference shareholder, you will return it back to that preference shareholder. Irredeemable is where you don't redeem. Irredeemable preference shares are not allowed to be issued in India, so you can issue only redeemable shares which have to be redeemed maximum within a period of 20 years. Now, rights issue and bonus issue is something which I have already discussed earlier. Coming to sweat equity shares, sweat equity shares is where I am issuing my shares. I am giving an option to the employees of the company to motivate the employees of the company I give them an option saying that if you attain this objects or if you stay with me for this number of years, then I will be issuing you equity shares in the company, and that is called as sweat equity shares. It's always issued at a discount, so they get it at less than the market value, and they have an option whether they want to subscribe or not subscribe to the equity shares. These sweat equity shares are always excluded when you're making the calculation for private company or when you're making the calculation for private placement. Transfer and transmission of shares, there's a register of members. If there is any transfer or transmission of shares, you make an application to the company is supposed to take it on record, make a give an acknowledgement to the shareholder, and make the necessary filings with the ROC. That's called transfer and transmission of shares. Transmission is when there's a death and the shares are transferred to some other person. Bonus issue, again we've discussed, can be issued out of free reserves and securities premium but cannot be issued out of revaluation reserve. Please remember. Now coming to the different type of debentures. Debentures are basically the debt or the loan which the company has taken. On the basis of security, it has to be a secured or unsecured. So if I take any security against the loan that I'm giving the company, that's called secured, otherwise it's called unsecured. Again, convertibility to shares, whether debentures will be converted into equity shares, it will be convertible. If it's not converted, then it's called non-convertible debentures. If it is in the interest of the company, the central government may, or the board of the National Company Law Tribunal may ask the company to convert the debentures into equity shares, but that is only in exceptional scenarios. On the basis of redeemability, there are redeemable debentures and irredeemable debentures. Now coming to registration of charge. So if I am taking any loan, the bank or the financial institution from where I am taking the loan is not going to give me the loan for free. So normally they would take a charge on the assets. There are two different types of charge. Charge is basically like a mortgage. There are two different types of charge. One is a fixed charge and one is the floating charge. Fixed charge is where they determine, okay, I keep a charge on the computer, I keep your charge on the iPad, where they determine the assets and the charge is on the specific asset. It's called as a fixed charge. So if I don't pay the loan tomorrow, he has the right to come and take my computer away. In case of floating charge, it's a fluctuating charge. It's not on a particular asset. It's on an asset which is an ongoing item. So I say that, you've taken a 6 lakh rupee loan. That 6 lakh is against your stock in trade. So the stock in trade does not mean you can, not sell that stock. You will obviously sell your stock, and in the future, if you don't pay, then that stock in trade which you have at that point of time, out of that 6 lakhs will be recovered. So that is called as a fluctuating charge, which is normally on debtors or stock in trade or things like that. Now, once you have taken a charge, you will have to inform the ROC, give a notice saying that, okay, I have taken the charge from the date of registration of charge. From the date of registration of charge, you will have to give a notice saying that, okay, I have taken a charge is against this asset, it's a fixed charge or it's a fluctuating charge, whatever it is, you will have to inform the ROC about it. And once you have satisfied the charge, again then you will have to inform the ROC about it, saying within a period of 300 days, saying that, okay, this charge has been satisfied. And if you do not inform, and if the ROC comes to know from some third party that the charge has been satisfied, then the ROC will give you a 15 days notice for you to reply back. If you do not reply back, it will note in the register that the charge has been satisfied. Every person who is dealing with the company is deemed to have the notice of the charge on the assets of the company. Even if you have not specifically told them, they are deemed to be aware of it, because this is a publicly available document. Now, when to register the charge? If the charge has been created before 2nd of November 2018 and after 2nd of November 2018, then the process is different. Before 2nd of November 2018, you have to register it within 30 days of creation. If you have not registered it within a period of 30 days, you get additional 300 days on payment of additional fees. You can still register within a period of 300 days. And if you've still not registered within period of 300 days, on 2nd November, you have given an option that within a period of 6 months from 2nd November, you have to register the charge. This is what was applicable earlier. So you get 330 days to register the charge. In case the charge is created post 2nd November. So now if you create the charge, you'll have to register it within a period of 30 days. If you don't register within a period of 30 days, you get additional 30 days, which is 60 days from the creation. So now the time period has been reduced. And if you don't do that, then you get a further period of 60 days. So what you were getting 330 days for the purpose of registration of charge. Post 2nd November 18, you get total of 120 days for registration of the charge, and satisfaction of the charge has to be informed and filed with the ROC. Now coming to the meetings of the company. Meetings, you have the general meetings, but before we go to meetings, we'll quickly go through the things which are required before the meeting takes place. Okay. So before I have the meeting, first thing I would want to do is give a notice. I have to give a 21 days clear notice for the purpose of the meeting. So I have to give the members a 21 days clear notice. The date of the meeting is excluded while calculating the 21 day period. If I am sending a notice by post, then 48 hours from the notice will be effective 48 hours from the date the notice has been posted by post. So I'll have to give the notice. Notice of the meeting has to be given to the members, to the legal representatives of the deceased members, to the assignee of insolvent members, to the auditors of the company, and to the every director of the company. So these are the people who are going to get the notice for the meeting. Now coming to the quorum. Once I have given the notice and I have to have fixed number of people coming and attending the meeting. How many people? I need to have minimum number of people attending the meeting, which is called as the quorum. That depends, that's different for a public company and a private company. For a private company, I need 2 members to be personally present for the meeting. If I have them present within half an hour from the time the meeting has been scheduled, then it will be said that the quorum is present. In case of a public company, because there are a lot of members in the public company, it's divided into 3 parts. If the number of members are less than 1000, then it's 1000 to 5000, and then more than 5000. So 5, 15, 30 is what you have to remember. If you have less than 1000 members, you need 5. 1000 to 5000 members, you need 15, and more than 5000 members, you need at least 30 people to be personally present at the meeting. Now once I have had the I have given the notice, I have got the quorum. Now we will discuss about the meetings of the company. Before I do that, one more important thing which we will discuss is the registers of the company. Registers of the company is covered under section 88 of the company, which basically determines that you will have register of members giving details of who are the shareholders of the company, and if the shares are transferred, then who are the people to whom it's transferred, on what date it is transferred. All of these details will be mentioned in the register of members under section 88 of the Act. Now you will have register of members where you have recorded the equity and preference shareholders. You will have register of debenture holders, significant beneficial owners, and any other security holders. So all of these registers will be kept by the company for inspection, available to the public. Coming to annual return. Annual return is basically a return which has to be filed by the company to the ROC, and it has to be giving the details of the entire thing that they have, all the things that they have done during the year, depending on the directors, new auditors appointed, new directors appointed, directors retiring by rotation, auditors retiring, or what are the financials of the company, how much profit and loss has been made by the company, if there is any charge created by the company. All of these things, everything that you've done in the year has to be informed to the ROC in the form of annual return. So annual return is a very, very important document of the company, and it has to be filed every year by the company with the ROC. Now when does it have to be filed? Now signing of annual return has to be done. If you are a one-person company, then it can be signed by the director or the company secretary. If you don't have the company secretary, then the director will sign it. And in case of a private company, you will have a director and the company secretary signing it. If you don't have the company secretary in-house, you can have a company secretary in practice signing it. Then coming to certification of annual return, again it can be done by a CS in practice. Filing of annual return. When will you file the annual return? You will have to hold a AGM of the company. So once you hold the AGM of the company, in the AGM of the company, normally the annual return is made available to the shareholders for review, and then once that has been reviewed, within 60 days from the date when the AGM is held, you will have to file the annual return of the company to the ROC. Now if you say, if I have not filed, if I have not held the AGM, then when will I file the annual return? If you have not held the AGM during the year, then you will have to file it within 60 days from the date when the AGM has to be held by the company, from the date the AGM was due to be held by the company. Again, this is a very important question because that has been asked as a practical case study type of questions many a times in your paper. So again repeating, you have to file annual return within 60 days from the day you hold the AGM in the company. If you do not hold the AGM, then within 60 days from the day on which the AGM was due to be held. And the annual return has to be kept at the registered office of the company. You can keep it at any other place if you wish to, but that has to be approved by 1/10 of the total number of members entered in the register and approved by a special resolution. Inspection. Now the members, the debenture holders, all of these people are can inspect the registers or the documents of the company, the annual return of the company, the register of members. Everything can be inspected, minutes of the meeting, everything can be inspected by the people, by the members, the debenture holders or any other general public at large on the payment of certain fees. And once you make the fees payment, the company has to make available the data. This clause is not really applicable now because it's all available online. You just have to pay fees and you can view it immediately. Now coming to AGM, again very important. AGM is the annual general meeting of the company. EGM is extraordinary general meeting. Annual general meeting, as the name says, is annual general meeting, so it has to be held every year. When do you have to hold an annual general meeting? Annual general meeting has to be held within a period of 6 months from the end of financial year, which means on 30th of September. If you do not hold it within a period of 6 months due to certain circumstances, you can make an application to the registrar to extend it for a further period of 3 months. So to give you an example, now in COVID, if everything was under a strict lockdown and if you can't hold your AGM in September, then you would want to extend the period and the registrar will give you an application for extending the period. If it's your first AGM, then you get 9 months from the end of the financial year to hold your AGM. So first AGM you have to hold within a period of 9 months from the end of the financial year. If it's a subsequent AGM, it can be held within a period of 6 months from the end of the financial year, can be extended by 3 months if the registrar so feels. Okay, where will the annual general meeting be held? Again, please note, this is very important. This can be asked in any descriptive or practical case study type of questions. Place of AGM, where will it be held? It can be held in case of a government company in the registered office, or in any other place as the central government may approve. In any other company which is not a government company, you can have it at the registered office or any other place within the city, town or village. Or if it's an unlisted company, they can hold a meeting anywhere in India, provided all the members are informed in advance and they have approved about the holding of the AGM. So AGM is the most important meeting of the company, where the entire year that has gone by is being discussed, and it has to be held by the company, or there are penal consequences for the company and the director responsible. Now calling of EGM. EGM is when the members feel that there's a need to call for a meeting. So if I want to raise funds in the middle of the year, I'm not going to wait till the next year of September to call a AGM and then raise the funds. I would want to call a EGM and discuss it with the members, get the approval and raise the funds. So in that case, I will call for a EGM. EGM can be requisitioned by members holding 1/10 of the paid up capital in the company, and if it doesn't have share capital, 1/10 of the total voting power in the company. So these are the people, they can request the company to hold the AGM. Now they have requested the company has to hold the AGM after 21 days from the date when the requisition has been received, but no later than 45 days. If till 45 days they do not hold the the EGM, then in that case the members, the shareholders who have put the requisition for the holding of the EGM can themselves call for EGM and hold the EGM, and that has to be done within a period of 3 months from the date on which the requisition has been made. And within 3 months from the date on which the requisition has been made, and and whatever expenses that they have incurred can be recovered from the company. EGM of company other than wholly owned subsidiary shall be held at any place within India. Okay, now notice is something which we've discussed. Meeting can be, I said I have to hold a meeting at 21 days notice, but if there are certain scenario where I can't wait for 21 days and I want to hold it before 21 days or within 15 days or 18 days, whatever the case may be, then 95% of the members have to approve that holding of AGM at a shorter period of time. If they approve, then I can hold it at shorter period of time and I do not have to wait for 21 days. Then coming to the different types of business which are being transacted at AGM. So normally I said AGM is to discuss the the things which are happening during the year. So the most common things which are to be discussed in an AGM is the financial statements and the annual return of the company, the directors who are going to be appointed, or the auditors who are going to be appointed, or directors if they are retiring, someone who's been going to be appointed in their place, or any dividend which I feel that I want to declare in the company. All of these things are to be discussed in the AGM. These are all ordinary business. Anything other than these 4 things, if I want to discuss, that will be called as a special business. If I am going to discuss special business, so at the same time I discuss that, okay, I am going to we are going to call for a IPO and we are going to raise funds. That is not covered in the ordinary business. That's a special business. My notice will mention in the notice that, okay, we are also going to discuss special business and this is the special business that is going to be discussed. So that's the difference between ordinary business and special business. Ordinary business are 4 things which are common: annual return, directors, auditors and dividend. Anything apart from these 4 things, it will be considered to be a special business. Now quorum is something again we discussed. Proxy is when I am not going to be attending the meeting. So I will send someone saying, okay, 21 days I am going to be in Europe, I am not going to be attending the meeting. So I send someone in my place saying go and attend the meeting. Proxy is a person who can go attend the meeting, he can listen, see everything, he can vote at the meeting, but he cannot speak at the meeting. So he can just go and vote at the meeting based on what he's discussed with the member. Any proxy who's been appointed 48 hours before the meeting will be a valid proxy and they can come and attend the meeting. Voting. Now once proxy is there, quorum is there, notice has been sent, final thing what will happen is the voting. There are 4 different ways in the voting in which the voting will happen. First is voting by show of hands. So the members will show, all those in favor of resolution raise your hands, not in favor raise your hands. They will count the number of votes and the resolution will be passed. Second is voting by electronic means. I am a public company, I have more than 5,000 members. I cannot have a show of hands because I can't sit and count like for every resolution how many people are doing. So I tell them, okay, whatever the resolutions are proposed to be passed in the meeting, I'll put them up on the website, and then you can go on the website and then just read the resolution, click favor or against, and then that is voting by electronic means. Even if you voted by electronic means, you can come and attend at the meeting and you can listen to whatever is happening at the meeting. That is voting by electronic means. Voting by poll. You've seen Kaun Banega Crorepati, people coming and Janta ka vote, and everyone's by poll clicking on what would the correct answer be. Similarly, they're all sitting and they say this is a resolution being passed, now we'll decide by poll, and then people will vote whether in favor or against. That is voting by poll. Last is voting by postal ballot. That's the most important thing. It's reserved for only particular matters like change in memorandum, change in article, anything which is important, or change in the object clause of the company. Anything which is very, very important, there's a list given for which you can do postal ballot. So you can do those postal ballot, and voting by postal ballot is available so that people who cannot attend at the meeting, which is supposed to be like a very important meeting, they can by registered post cast their vote. In case of voting by poll and voting by postal ballot, in both these cases, a scrutinizer will be appointed who will count the votes, will be like a third party, independent third party, who will count the votes and then pass the resolution whether in favor or against. Now coming to resolution. There are two types of resolutions, ordinary resolution and special resolution. Ordinary resolution, where more than 50% people agreeing to it, it's called an ordinary resolution. Special resolution is where more than 75% of the people are supposed to agree with it. Special resolution, wherever it's required, it's given in the act saying that okay, these are the cases, these are the scenarios where you will require a special resolution. If I am removing an auditor, if I am changing my articles of association, all of these, I am changing the object clause of the company, all of these things they have mentioned require special resolution. Change of name requires special resolution. All of these things where special resolution are required, which means that if you want to change the name of the company, if you want to remove the auditor of the company, you will have to have 75% of the members agreeing to removing the auditor or changing the name of the company, and only then you can go ahead with that particular transaction. So if you need a specified majority, if you need to pass a special resolution, your notice will state that okay, this is a matter which requires a special resolution and a special resolution will be passed, and hence we need 75% of the members approving it. Now coming to the minutes of the meeting. So a chairman has been appointed who will be, attending the meeting, who will be taking the poll and making sure that the decorum of the meeting has been maintained. He is also the person who is responsible for maintaining the minutes of the meeting. Minutes of the meeting is nothing but giving out the details of what exactly happened at the meeting, writing it down so that people who have missed or for future reference, you can refer back to what happened at the meeting, because not everyone's going to remember everything and not everyone's going to live. So you have to give the minutes of the meeting, and the minutes of the meeting are to be given by the chairman of the company. Now, when the chairman is giving the minutes of the meeting, he has the flexibility to decide what can be put in the minutes of the meeting. He obviously can't state something which is not true, but if he feels that there is something which is detrimental to the interest of the company, or if there is something which is defamatory or something which is not significant, like I asked them how's the COVID scenario in your city, obviously it's not relevant for the minutes of the meeting, and such things will not be covered, and the chairman has the right to exclude such things from the minutes of the meeting. Now coming to dividend. Dividend is when the company has earned profits and wants to share that profits with the shareholders of the company. They give out certain profits as by way of dividend to the shareholders of the company. Now डिविडेंड कैन बी फॉर प्रेफरेंस शेयर्स और फॉर इक्विटी शेयर्स. प्रेफरेंस शेयर्स का फिक्स्ड होगा, क्यूमुलेटिव होगा तो इट कैन बी कैरिड फॉरवर्ड, नॉन क्यूमुलेटिव होगा देन यू विल हैव टू गिव इट बैक in the same year. And equity shares, based on how much profit is available after paying off preference shareholders, will be available for equity shareholders. Dividend can be paid out of what? It can be paid out of current year's profits or accumulated profits of the previous financial year, or both. Once you are paying the dividend, you have to transfer a certain amount to the reserves account for safety for future working of the company. It is not mandatory to transfer a certain percentage to the reserves account, but you can transfer. Again, important, because this has been asked in practical case study type of questions. It's not mandatory to transfer an amount to the reserve account, but you can transfer an amount which the company likes to the reserve account. And depositing the amount of dividend. So I once declared that okay, 10% dividend will be declared, then within 5 days I have to deposit the amount to any scheduled bank, saying that this is the amount of dividend which will be paid to the shareholders of the company. How much can be the rate of dividend? If I have not paid any dividend in the previous year, then I can give a rate which I determine this year. But if I have declared dividend in the past 3 years, then it will be the average of the last 3 years dividend which I have given to the shareholders of the company. What will be the amount that can be withdrawn out of accumulated profits? Amount cannot be, the amount which you withdraw from the accumulated profits cannot be more than 1/10 of the paid up share capital and free reserves of the company. And what balance reserve has to be maintained? All of these are precautions to be kept by the company so that all the funds are not given away and there is funds available for the working of the company. So reserve account cannot be less than 15% of the paid up capital as per the last audited financial statement. It has to be more than 15% of the paid up share capital. How will I pay the dividend? I can pay it in cash, I can pay it in check, I can pay it dividend warrant, or any other mode. I can give a demand draft, whatever. Any other mode, I can electronic mode, I can pay the dividend. Dividend has to be paid to the registered shareholder to his bank account only. Okay, or to his order or to his banker's order. Declared dividend. Now I've declared dividend saying okay, I'll be paying 10% dividend. I've transferred the dividend to the scheduled bank account, but the dividend has not been paid or claimed. 30 days ho gaya, no one's claimed that dividend. 7 days I wait. Within 7 days I will have to transfer it to a scheduled bank account, and that scheduled bank account will be the title to that scheduled bank account would be unpaid dividend account. So whatever dividend I've declared and the shareholders has not claimed it, or if I've sent it to their address and it's come back, it will all go to the unpaid dividend account. In the future, if the shareholder comes back saying that okay, you know what, dividend was declared but I haven't received it, then I will have to pay them. They will make a request to the company and the company will pay it out of the unpaid dividend account. If they don't come for a period of 7 years from the date when it's transferred to the unpaid dividend account, then in that case I will have to transfer it to the Investor Education and Protection Fund. So it will go to the Investor Education and Protection Fund. If I don't deposit the amount to the unpaid dividend account within a period of 7 days, then I will have to pay interest at the rate of 12% per annum from the date of the default. Okay. Now punishment, again, if you don't comply with the provisions, there are punishment, whatever the failure is, you can read through the penalty for the director and the company both. When exceptions, when there will be no offense committed, when the dividend could not be paid because of operation of any law, or the shareholders gave direction regarding payment of dividend, whether they wanted, don't wanted, dispute regarding the right to receive dividend, the shares have been transferred, who will get the dividend, whose name was registered at that point of time. Dividend has been lawfully adjusted against any sum due from the shareholder. The shareholder was supposed to pay the amount, that amount has been adjusted, so now nothing has to be transferred to unpaid dividend. Or for any other reason, failure to pay post-dividend warrant within prescribed time was not due to the default on the part of the company. If company is not at default, company will not be punishable. So that is about dividend. Now coming to the accounts of the companies. Accounts of the companies, what are the accounts of the companies? The most important things are the balance sheet, obviously profit and loss account, income expenditure account, cash flow statement, statement of change in equity if applicable, not always, it keeps changing, any explanatory notes annexed to or forming part of the financial statement. In case of OPC, small company, dormant company, the cash flow statements will not be considered to be a part of the financial statement because they are not supposed to give it. Financial statements which the company gives has to give a true and fair view, has to comply with the accounting standards and the Schedule 3 of the Companies Act. And at each AGM, the Board of Directors shall lay the financial statements for the financial year. If you have a subsidiary company, you will have to lay the consolidated financial statements. Now, what all company shall prepare? It shall prepare the books of accounts, books and papers, financial statements, and this will be available for inspection. If you go on the NCA website, you can pay 100 rupees and you can have a look at the financial statement of any company you like. Okay, so it's preserved for a period of 8 years. You can pay the fees and you can have a look at it. If the company does not make available, then the company will be fined, imprisonment up to 1 year, or fine of 50,000 to 5 lakhs, or both. And in some cases, reopening of accounts is required. So if there is any authority like SEBI, income tax, RBI, any authority which feels that the financial statements given by the company are not correct and they need to reopen and reassess the financial statements, then in that case they'll make an order and the company will have to reassess the financial statements after being given an opportunity of being heard. Now, in certain cases, the directors themselves may feel that, okay, we need to reopen the financial statements or revise the financial statements, and they will make an application to the registrar saying that we believe that the financial statements have to be revised, and in that case, it's voluntary revision of financial statements, and in both the cases, whatever the revised financial statements are will be considered to be the financial documents of the company or the books of the company. Then coming to the board of directors report. Board of directors are the people who are actually functioning the company or are taking care of the company. So they are responsible and answerable to the shareholders and to the company, and they have to give the board of directors report. The board of directors report again is an exhaustive report which gives details about the number of meetings held, directors' responsibility report, fraud reported by auditors, declaration by ID, company policy, commitment on board of remarks, particulars of loan taken, state of company affairs, contracts with related parties. So everything that they have done, all of these are to be reported by the board to the shareholders and to the company. So that these are the contents of the board of directors, again can be asked in the examination. Now, once you have the copies of the financial statements, whom do you have to send it to? You have to send it to every member, to the trustee of the debenture holder, any other person, 21 days before the general meeting. So they have time to review the documents, and then they can send it within in a lesser time frame. So before for less than 21 days, if 95% of the paid up share capital of the company gives 95% of the members or 95% of the members holding the paid up share capital agree to it. Okay. In case of listed companies, they will have to give it to the members and the trustee or the debenture holders 21 days before the meeting. And manner of circulation, it will be done by electronic mode, or it can be done by dispatch of physical copy. So if there are shareholders who are holding shares in dematerialized form or who have requested give me the financial statements in the electronic form, they will be given the financial statements and annual return in the electronic form. Otherwise they will be given physical hard copies which will be sent to them. Now, financial statements to be filed with the registrar of the company. So once the financial statements are approved at the general meeting, you will have to file it with the registrar of companies. So if the AGM has been held, then you will have to file it within the copy of the financial statements which have been adopted at the AGM within a period of 30 days from the date of AGM. If they are not adopted at the AGM, so the shareholders don't agree with the financial statements which have been submitted by the board of directors at the AGM, then in that case the unaudited financial statements will be filed with the registrar of companies, and then within a further period of 30 days the final adopted financial statements will be filed with the registrar of companies. If the AGM has not been held, then within 30 days from the date the AGM should have been held, you will file the financial statements with the ROC. Now, companies' internal audit. Which are the companies which require internal audit? Three type of companies: listed company, unlisted public company, and private company. Listed company will require internal audit if the paid up share capital is 50 crores or more, or the turnover is 200 crores or more. If you are an unlisted public company, you will have to have an internal audit done if your loan or borrowings are more than 100 crores or the outstanding deposits are more than 25 crores. If you are a private company, you have to get an internal audit done if you have a turnover of more than 200 crores or outstanding loans of more than 100 crores. Who can do the internal audit of the company? A CA can do, or a cost accountant can do, or any other professional who has been decided by the board. Now, audit and auditors. Who are the first auditors of the company? So, auditors of the company in case of any other company will be determined by the board of directors. Board of directors will decide within a period of 30 days of registration who shall do the audit of the company. And if the board of directors does not appoint, then the members shall appoint the auditors within 90 days of EGM. So they will call a EGM, and within 90 days of EGM they will appoint the auditor who will hold the office till the conclusion of the first AGM. In case of a government company, the CNAG, Controller and Auditor General of India, shall appoint the auditor within a period of 60 days from date of registration. If he does not appoint within 60 days, board shall appoint within the next 30 days. If the board does not appoint within the next 30 days, then the company shall appoint the first auditor within 60 days of the EGM, who will hold the office till the conclusion of the first AGM. Now subsequent auditors. In other companies, subsequent auditors will be appointed, and once he's been appointed, then he will hold the office till the conclusion of the 6th AGM. In case of government company, appointed by CNAG for a financial year within 180 days of commencement of the financial year, and will conclude for the will hold for a period of 1 year till the conclusion of the AGM. Okay, so for government company, central and CNAG will appoint, and in other company the board of directors will appoint, but here they will hold office till conclusion of next AGM. Here they will hold office till the conclusion of the 6th AGM. Again, important for a practical case study type of question. Now, casual vacancy of auditor, again in case of a government company, will be filled by CNAG within 30 days. In other company will be filled by the board within 30 days. If the board does not do, then the members can appoint the auditor. If CNAG does not fill, then the board can fill up the auditor's vacancy within a period of 30 days. Appointment of a retiring auditor. If a person is retiring, the auditor is retiring, you can appoint the same person. If he is not disqualified for reappointment, he has not given notice in writing for reappointment, or a special resolution has not been passed saying that he will not be again appointed, he is retiring auditor. When will he be disqualified? If auditor is an individual, then he can hold for a maximum time of 5 consecutive years. If he is a firm, he can hold 2 terms of 5 consecutive years, that is a period of 10 years. Then there is a cooling period of 5 years, which means for 5 years the same audit firm or the same auditor will not be appointed. And even if a partner of this firm is a partner in other firm, that firm will also be not allowed to be the auditor of the company. So the cooling period of 5 years is applicable to the firm and the partners both. And this is in case of special companies, how the rotation of auditors happens. It is in case of special companies and listed companies only, not applicable to private company. Which are the special companies? Unlisted public companies having paid up capital of 10 crores or more. Private companies with 50 crores or more turnover. Sorry, I said not private companies. Not all private companies is what I meant. And companies having paid up share capital and public borrowings or public deposits of 50 crores or more. So in these cases, because these companies are very big companies, you need to change the auditor so that the auditors are not hand in glove with the board of directors. Okay. Now steps for removal of auditor. Now if I feel at any point of time that the auditor is not the perfect auditor for the company and we need to remove the auditor under special scenarios only, then I will have to give a special notice for the removal of the auditor. A board meeting will be held and the matter will be discussed. Application will also have to be made to the central government within 30 days of the board meeting saying that we want to remove the auditor. Central government will take into consideration what the company has given. It will also call the auditor and give him an opportunity of being heard, and then he will pass a approval, and the auditor can be removed by special resolution. See here, auditor removing special resolution, which means 75% or more of the members have to agree, and once they have agreed, then the auditor will be removed. If there is resignation by the auditor, then that has to be filed with within 30 days from date of resignation. It has to be filed with the ROC. If it's a government company, because CNAG is also involved, then you will have to also file a form with the CAG within 30 days of resignation by the auditor. In case of non-compliance, penalty under the particular section will be charged. Now, if there is again penalty when it's charged, depends on whether the default is willful or not willful. If it's willful, which means as mens rea is purposely done something wrong, then the penalty and the penal fees would be higher. So that gets an end. The notes here would also have the list of penalties which you can go through before your examination to determine what are the penalties levied. Just quickly revising the deposits. Deposits are basically nothing but deposit, loan or any other form. The money which has been received by the company which is considered to be deposit. Now rule 21C on the deposits rule give you the scenarios under which the money which has been received by the company will not be considered to be a deposit. You are supposed to go through those things because those are very, very important and have been asked in your practical case study type of questions for your examination. So please go through this category under rule 21C and remember the points and the scenarios under which money received by the company is not considered to be a deposit. Who are eligible to accept deposits? Any public company can accept deposits from the public at large if it has a net worth of more than 100 crores or a turnover of more than 500 crores. A special resolution has been passed, more than 75% people agreeing to it, and the special resolution has been filed with ROC. If these cases are fulfilled, then you can accept deposits from the public at large. Which companies are exempted from these requirements? Here you have the banking company, NBFC, housing finance company, other company which have been specified by the central government in consultation with RBI, because obviously they do accept money from the public at large. So this is what your deposit is, and this ends your company law revision. I hope you found this lecture useful and will help you in your revision. Wish you all the very best. Be confident and you will be doing exceptionally well in your examination. Thank you so much.